All right. I think we should probably get going. You're ready, Brent?
I am.
Okay, so welcome back, everybody. Just a reminder, we were just sort of running this like a regular seminar. So if you have questions, unmute your mic and ask it. Otherwise, Brent, have at it. Thanks for coming.
Excellent. Well, so first, thank you to George and Kim and Jonathan and Sam for running this. It's an awesome service to the profession, and thanks for having me come give this paper. This is joint work with Antonio Coppola at Harvard and Matteo Maggiore at Stanford and Jesse Schrager at Columbia. In case it's helpful to follow along, I've pasted into the chat the Dropbox link to these slides, so you can go ahead and check that out if that's helpful. And if any questions pop up where you think it's easier to resolve them privately versus publicly, Matteo Maggiore is here and can certainly answer anything that you can think to ask. And with that, let me get started. So this is a paper on bilateral investment patterns and the role of cross-border financing or offshore issuance and tax havens in understanding that. So let me start with this first slide, which I think gives an idea of what the paper is about. When we think of emerging markets or developing countries opening up, liberalizing their capital markets and seeking or allowing foreign investors to come in, sort of think of something like this plot, which shows Petrobras, the Brazilian energy giant down there in South America, at least potentially getting money from the red figurines, which are US investors, or the blue figurines, which are the EMU investors. But when you actually look at the data, this pattern is not really what it looks like. So instead, we find that there's essentially no bonds issued directly by this Brazilian parent and held in the portfolios in our data, which I'll describe in a little bit, by American investors or European investors. Now, it's not that the American investors and the European investors aren't lending to Petrobras. It's just that they're lending through intermediaries that are located offshore affiliates of Petrobras. So here's an example. Petrobras has set up in the Cayman Islands something called the Petrobras International Finance Company. And it's that entity that issues bonds that the Americans and the Europeans then buy, in this case, several $billion. Or similarly, it's not just that one. Petrobras also issues or has these affiliates like these two in the Netherlands. And it's those companies in the Netherlands that actually receive the investment flows, the investments from the American and European investors. In our data, this is $11 billion worth or so. Now, in international statistics, so let's say, for example, in the US Treasury International Capital data, the TIC data, which is the bilateral investment positions that underpin the US balance of payments accounts. It says where the Americans are investing, what countries are issuing bonds that the Americans are holding. And in this example here, they would not show that Americans are investing a lot in Petrobras, or in Brazil, I should say. Instead, in those national statistics, it's going to make it seem like the Americans are buying a lot of bonds issued by Cayman Island companies, which of course is true, but is not necessarily of economic use. For most of what we would want to think about with those data, you would want to associate the American position in Petrobras Cayman Islands with Brazil. And similarly, this is going to show the US holds a lot of bonds and stocks issued by Dutch companies, even though in this case we would want to associate that with Brazil. So what the paper is all about doing is essentially fleshing this out and trying to sort of undo the damage that this does to certain official statistics, and then draw out some implications that come about from what would be a restated map of global portfolio flows or portfolio investments. So this is just an example of one bond.
Can I interrupt you for a second? The last picture, are there also flows coming from the Netherlands and Cayman Islands somehow to Brazil? I mean, how is it finally making it to where they need to pay for workers to put in an oil well or something.
Totally. In most of what I'm going to present today, we're going to assume, I mean, we don't actually have to take a stance one way or the other, but I'm fine if you have in your mind that what happens is the Americans buy a bond for $1 issued by the Cayman Island affiliate, and then an intercompany transfer, which is classified as FDI, is then made between that Cayman Island affiliate and Petrobras in Brazil, such that Brazil's multilateral position, the amount that it's borrowing from all of the rest of the world, merging the US and Caymans, is invariant to the point that we're making. Most of what I'm going to talk about for the first 2/3 of this talk will be about the bilateral pattern. That said, at the very end, there's going to be one very important and very large exception. It's going to be where there's a multilateral implication of this offshore issuance, and that's going to be the case of China. But if you could just give me 40 minutes, 45 minutes, and then I'll get there. But until I alert you otherwise, I'm fine with you thinking of this as very relevant for the bilateral pattern, less relevant for any country's multilateral external liabilities. Sam, does that answer it?
Entrepot trade, in a sense.
For now, I'm okay with that. In the China case, it's going to be different. Okay. So this Petrobras bond, for example, is one. Here's the QSIP. A QSIP, I'm going to use that word a few times, is like a barcode essentially for a security. And it would list the Cayman Islands issuance as, you know, a U.S. investment in the Cayman Islands, and in particular in the finance or banking sector. And what we're going to do is we're going to combine information from 7 commercially available sources to figure out that flow from the US or Europe or any of the countries in our data sets to the Cayman Islands should instead, in some economic sense, be thought of as an investment in Brazil's energy sector. And, you know, that the ultimate parent is a Brazilian energy company. So the first question is, how big a deal is this? It might sound like a kind of nuanced, esoteric thing. It's actually enormous. So tax havens, and I'm going to abbreviate tax havens with TH through a lot of the talk, so you know what's coming. They actually account for more than 10% of all cross-border portfolio positions. So an example would be in the US TIC data of all the foreign portfolio holdings, stocks and bonds that Americans are invested in issued by firms abroad, 14% of them are associated with the Cayman Islands. And again, the Cayman Islands is a country with a GDP of something like $2 billion. So this is absolutely huge. If you instead think of it as what share of total corporate bond and stock financing is accounted for by issuances from their offshore affiliates in tax havens, you also get huge numbers like 10%. Then finally, if you want to think of it as, you know, of cross-border issuances, in other words, of cases where a company issues through any offshore affiliate, how much of that is done in a tax haven like the Cayman Islands, we actually get something like 50%. So it's really, really a big deal quantitatively. It's also very concentrated. So if you look at some emerging markets, you know, like Russia, let's say, almost all of their corporate sectors bond financing from rich country investors, from developed market investors, flows through these tax havens. So, you know, you'll see in a little bit, America, you know, the US, Europe, they're generally not directly buying corporate bonds issued by Russian companies. They're much more likely to issue them, to buy them when they're issued by Russian companies, but via affiliates in tax havens. And furthermore, this issue appears to be growing in importance. So the paper has some plots of the time series, and you can think of this as becoming a bigger and bigger deal. So what are the takeaways? What are we going to get to at the end? Well, first, you know, at the most basic level, these bilateral investment positions data try to tell you what exposures a given country has to another country. So, you know, the US data should in principle tell you something about what exposures US wealth has to what countries in the world. But if you actually use the standard Treasury International Capital data, the TIC data that underlies, again, the US balance of payments, you'll find that the holdings listed for Chinese securities is well under, you know, I think it's about $160 billion, we think it's underestimated by on the order of $600 billion, something like 4 or 5 times underestimated. So it's a really big deal quantitatively. There's also some qualitative things that emerge. So one is, in addition to this developed market exposure to just large EMs in general, like Brazil and Russia and India and China and South Africa, in addition to the US and developed country exposures being much larger to those countries, the type of exposure looks a bit different. So for example, when we affiliate offshore issuances with parents, we're very much affecting corporate bond investment. But we're doing almost no damage to the data on sovereign or government bond investments, since you can imagine the government of Brazil does not really issue through offshore affiliates. And so we're going to make corporate bonds look much more prominent than relative to government bonds in those flows. And there's going to be some implications also of that for the foreign currency exposure of that portfolio investing. And finally, we're even going to find that some foreign investments aren't really foreign at all. So for example, hundreds of billions of dollars in the data of US investment in equities issued by Irish companies, we're going to find are really reflecting tax inversions, and instead should be thought of as essentially domestic investment by US investors. And so some foreign investment we think is sort of spurious and should in fact be considered domestic. The last part, which I'll save till I get there, but is what Sam Cordham was asking about earlier. We're going to show you that in the case of China, because they so commonly use offshore affiliates to issue, there's going to be an underestimate, we think, in the official data of China's NFA position, and a giant one, more than $1 trillion. Instead of having China be the second or third largest net creditor to the world with a very large net foreign asset position, we think, in fact, it's more like Norway or Switzerland or Sweden in the sense of having, maybe it's Singapore, but I'll get the specifics later, in the sense of having about half the scale that you otherwise would think. So I'll explain that when we get there. Finally, before digging in, we're not going to spend much time, really any time after this, talking about why firms issue through offshore affiliates, in particular why they issue so commonly in tax havens. That's not to say that this isn't fascinating. There's sort of a number of reasons why, and I think future work is going to try to elaborate on that. Instead, I just want to give you a flavor of what we think are the biggies, with the argument being that in almost every case, if we want to use as economists these economic data that tell us where certain countries are investing, in almost all of these cases, you would want to associate the investment with the parent and not with the offshore affiliate. So one of the biggest reasons that firms issue in tax havens is just to avoid taxation, sort of obviously. A lot of us might have in mind the corporate incentive. You could do things like, shift profits such that you realize more of your taxable income in a low tax jurisdiction. But almost equally important, maybe more important, actually, I don't want to say almost equally, maybe more important, is the fact that there are different withholding rules that affect the payouts made to bondholders, depending on whether you issue a bond from Brazil, let's say, versus issue a bond from the Cayman Islands. In exactly the same way that the University of Chicago withholds tax payments on my labor income, companies have to withhold payments on my interest income that I otherwise earn from holding their bonds. And those withholding rules are far more investor-friendly in tax havens. Number 2 here, I'm listing avoiding capital controls. In China's case, that's going to be the biggie, that China's going to list through this complicated structure that routes through Bermuda or the British Virgin Islands or the Cayman Islands in order to allow foreigners to directly invest, or I shouldn't say directly, to invest in what are otherwise restricted sectors in China. You could also avoid certain regulations with offshore issuance, access a different investor base. In all of these cases, we think it's useful for economists to be able to associate those positions with the parent company. So that's what we're going to be about. Given the somewhat short talk and unusual format, let me move past the related literature, but there's a large related literature. Just want to be very clear, we're certainly not the only people or the first people to have noticed the importance of tax haven and tax haven behavior in understanding international accounts. It's a nuisance that's been out there for a while. Instead, our paper is really focused on one way to handle this, to try to get around that nuisance and learn from it. So let me start by running into our methodology. I'm going to introduce first these terms that I'll use a few times: residency and nationality. So what does residency mean, or what are residency-based statistics? Residency-based statistics are statistics that associate a given purchase of a bond or stock with the geography of the immediate issuer. So in the sort of graph I showed you early on, under residency, if an American buys the bond of that Cayman Islands subsidiary of Petrobras, that's like a US investment to the Cayman Islands. That the country under residency would be the Caymans. And almost all official statistics follow the residency principle. For instance, again, the US balance of payments and TIC data that I'm going to focus on a little later, or for non-US countries, the source that we'll use is the Coordinated Portfolio Investment Survey, CPIS, by the IMF. Those are all recorded under the residency principle. By contrast, nationality is what we want to get at instead. It's if you instead associate those positions with the country of the ultimate parent or the operational headquarters. It would be Brazil in the example I gave earlier. Now, there's plenty of cases where residency and nationality fully coincide, where nothing interesting is going on. So the example I mentioned earlier about a Brazilian government bond, residency and nationality is going to by and large be the same there because countries don't issue through foreign affiliates. And ADRs might be another example that comes up, which also you don't have to worry about here. The statistics will properly capture that. There are also some cases where residency and nationality do not coincide, but they might not be of interest. Sorry, let me rephrase. It might not be clear that nationality is a better concept than residency. So let me give you the example of Toyota Motors North America. So Toyota, the parent company, is Japanese, but Toyota Motors has a real operational presence in the United States. If they issue bonds through their North American affiliate, by residency, that's a US bond. By nationality, that's a Japanese bond. And admittedly, for plenty of questions, you might not want to undo that. You might want to think of that as a US bond. For others, if you care, for instance, about corporate control, you might prefer the nationality basis. You might prefer thinking of that as a US investment in a Japanese company. One benefit of the algorithm that we're going to offer and provide publicly is it'll allow you to look at both notions. So you'll be able to choose, do I want to consider this full nationality where I include Toyota or not? What I'll instead focus on predominantly in the talk here is the case that I think is most clear-cut. Either the case of Petrobras I just described before, or of a tax inversion where a US company like Medtronic shifts its headquarters to Ireland to take advantage of tax rules. In those cases, I think it's much, much less controversial. You would almost always want to look at the statistics by nationality. So that's what I'm going to focus on here. Okay. How do we do this mapping? Well, we start by simply purchasing, and most of our universities and your universities will have access to at least a large subset of these data sets, but there's a bunch of commercial data sets that give some information that give you clues on where the nationality basis for a company would be. In some cases, it's literally that they tell you who the ultimate parent company is and where they're located. In other cases, they tell you something about the geographic distribution of revenues. And yet other cases, they tell you about the geographic distribution of employees. We put together our own data set, or algorithm, which I won't cover at length here, but which is available online for download. And one benefit is it allows you to play around with these assumptions if you want. It's transparent, replicable, adaptable. It, in fact, will run on any subset of these commercial data sources that you give it. So hopefully, if you find this an interesting and important topic, we want to emphasize that putting together multiple of these sources allows you to do better than if you just look at them individually. And let me give you an example. Imagine that there's a corporate hierarchy where company A owns B, and company B owns C. And one of the data sources links A to B, and the other links A to C, or sorry, B to C. Well, then the linkages between A and C in each data set on their own, of course, you would never make unless you had those two data sources pooled together for these purposes. So it's just an example of why this algorithm, sort of how it works. There are the crux of how I want you to think of the algorithm is when a company is headquartered in a tax haven, we look for evidence as to what non-tax haven country looks like the alternative parent. So if a company is listed in Bermuda, we look for the country that has the most employment or the most revenues or anything like that, that is not a tax haven, that's associated in that corporate ownership chain. That's largely what we're doing. The only exceptions are, some exceptions are cases that we handle manually, like Hong Kong or Luxembourg or Ireland. Those are examples of tax havens where there actually are sort of real operations, real companies. We don't want to automatically take Cathay Pacific out of Hong Kong. So in a case like that, we use human intelligence. We look at it and decide to preserve Hong Kong, Cathay Pacific in Hong Kong. Just to get a flavor for what these things look like. So here's an example of the largest issuer level reallocations removed from the Cayman Islands. So for instance, there's a Brazilian company called Vale, and they have something called Vale Overseas Limited that issues, $12 billion in the Cayman Islands that we instead reassociate with Brazil. Or Alibaba, which might come up later. It's the Chinese company, you all know, one of the largest, actually issues bonds through the Cayman Islands, but we want to associate that with China. Or IPIC is a UAE company that uses the Caymans, et cetera. So these are sort of the examples of the companies that we would associate with our algorithm away from Caymans and toward a non-tax haven parent country. Similarly, you can see these for equities. Notice that they're all very concentrated among Chinese firms. The largest Chinese firms, Tencent, Alibaba, Baidu, JD.com. All of these companies are actually not Chinese companies when you buy a share. If you go to the New York Stock Exchange and you buy a share in these companies, and through our retirement savings and mutual funds, my guess is most of us hold some exposures to these companies. It's not a Chinese firm whose equity we're buying. It's a Cayman Islands firm whose equity we're buying that happens to be an affiliate or associated with the Chinese underlying operations, and I'll explain all that later. Okay. Everything that I've shown you so far, or talked about so far, the algorithm, it simply looks at a security that's issued by a company, and it tries to ask, what is the ultimate country that we should associate that company with? But then we're going to merge that with a data set that tells us about how different countries around the world invest in those companies. In other words, we might know that Petrobras Caymans should be associated with Brazil and not Caymans. But now we want to understand, to what extent do Americans have exposure to that security? To what extent do the British have exposure to that security? So for that purpose, we're going to merge with this data set that we've developed from Morningstar data that is the basis of a paper in the JPE by Maggiore, Schrager, and I, where we've got security level holdings data for mutual funds and ETFs from 9 investor countries, 9 developed markets. So again, if we merge our mapping of company issuances with the countries of their parents, with these data on holdings of mutual funds and ETFs, I can compare US or British or European mutual fund holdings on a residency basis and on a nationality basis. And just picking the US as an example, that's what these 2 plots down here show. So the plot to the bottom left, and sorry, it's not labeled, I can see, but is for bonds. And it shows you US investments in bonds, about 10% of those positions, external, foreign bonds, in the Morningstar data, by residency are in Cayman Islands, or Luxembourg. You can see the big countries below and to the right of the horizontal line are countries that look bigger in these data under residency than they will under nationality. You can see the Netherlands, the British Virgin Islands, Bermuda. The countries, by contrast, above and to the left of this line are those countries where we're reclassifying, where we're shifting or reassociating those positions. So essentially, we're taking US investment exposures away from the Netherlands, Caymans, Luxembourg, Bermuda, British Virgin Islands, and we're giving it to Brazil, to China, to India, to Israel, to Russia, South Africa. Okay. Now, our ultimate goal is not to characterize mutual fund holdings per se. Rather, it's to characterize the total portfolio position, one major goal, the total portfolio position of the country. So what we're going to do is use the mutual fund data to learn about the patterns of when a given investor buys shares, let's say, or bonds in a tax haven affiliate that should be reallocated to Brazil or China. We're going to learn that pattern, assume it's representative, and then apply it to the broader holdings of the whole country, which includes not just mutual funds and ETFs, but also insurance funds and things like that, hedge funds, et cetera. So to do that, we're going to define this, what we call a reallocation matrix. Our reallocation matrices are specific to the investor country, and they're specific to the asset class. So in this case, it's specific to US corporate bonds. Well, US is the investor and corporate bonds is the asset class. And the way to read it is, of each country, which is the destination, where you're buying or investing, the row tells you how under nationality we would reapportion or reallocate those funds. So when Americans buy Brazilian bonds, this 100%, it means that we're going to leave it all in Brazil. We're not going to take any of those investments away from Brazil. But you can see the Cayman Islands, we're going to move a lot. So here's probably the best way to explain this chart. Let me hone in on this Caymans entry. The way to read this is, when Americans buy Cayman Island corporate bonds, only 1.4% of those do we keep essentially associated with the Caymans. 98.6% of the value of US investments in the Caymans are going to be allocated elsewhere under nationality. Here you can see that 20% of that we're going to associate with Brazil. 33% of that we're going to associate with China. The Petrobras case I showed you earlier would underlie this 20% here that I'm showing here, that would go into that calculation. Finally, you can see that when Americans buy Cayman Island corporate bonds, in fact, some of those appear to be issued by US companies themselves. I'll talk about that a little later, but this would be an example of a foreign investment that we don't even think is foreign. Now you might say, well, wait a second, why do you have to do this country by country? What do you need the Morningstar data for? Wouldn't it be sufficient to just say, look, most investment in the Caymans, goes to China. Let's just assume that's the case for the whole world's investment in the Caymans. In fact, the way in which investors are investing in tax havens differs, such that you really do need to do this country by country. Or put differently, this reallocation matrix I'm showing on the screen here looks pretty different if you do this for different investor countries. And one way to see this is just to note that there's what we call home bias in tax havens. So this is sort of an example where, in the United States, when Americans invest in securities issued in tax havens, about 30% of it is reallocated back to US companies. It's very common for Americans to be buying US parent securities issued through tax haven affiliates. The rest of the world, when they buy tax haven affiliate issuances, it's far less commonly associated with a US parent. So that's an example. These reallocation matrices are posted on our website that I sent via the chat So you can look at those over time for 9 different investor countries. So you can check out those patterns on your own.
Brent,
Okay.
I have a quick question.
Please.
Which is that when you've corrected the data and the way you have the bilateral flows, does it kind of look sort of more like a gravity model or something where, I mean, you must get rid of a lot of outliers for sure, but does it kind of fall into place nicely in that way? Or?
So first, I do just want to, and I might slip into using the word flows here, I did here, but first I just want to be crystal clear. What we're looking at is positions, investment positions, for exactly the reason that in your very first question, we have not yet done anything to track where the money goes once it goes to the Caymans, let's say. So I do want to be clear, it's bilateral positions. Your question is absolutely correct that any papers recent work by Koijin and Yogo that try to estimate a demand system for securities using the bilateral CPIS data. Any of that big literature, we hope will want to use our adjusted results, since those results might very much change. But we don't yet, we have not yet actually gone through it and sort of said this result changes in this way, et cetera, beyond what I'm going to focus on here. So it could be that gravity fits better or worse. It could be that the key sort of investment frictions that the literature has honed in on change. It could be that the elasticities change. We do think that's a fruitful thing to use our data for. And again, it's all out there on that website. Okay, so you saw this matrix that says essentially of investment in any given country, how do you reallocate it to other countries around the world? That's sort of what we've got. If you take the transpose and multiply it by the vector of residency-based holdings in TIC, in CPIS, then that will get you, it will generate a nationality-based vector. In other words, if I want to translate US national accounts from a residency basis to a nationality basis, I just need to take that matrix, which tells me, let's say, the row of the matrix corresponding to investment in the Caymans. Just need to multiply that row, by the Caymans amount, and it will say, give 1 billion to Brazil, give 2 billions to China, give 3 billion back to the US. I add that back up and I get a nationality-based statistic for each country. Again, what's the key assumption that we're making? We're assuming that within an investor-issuer country pair and within an asset class, that these funds, namely mutual funds and ETFs in our data, are representative of overall portfolio investment. So the idea would have to be, if 1/5 of US mutual fund investment in the Cayman Islands is associated with Brazilian parents, well, then we're also assuming that 1/5 of insurance fund investment in the Cayman Islands is also associated with Brazilian parents. That's the assumption. Okay. And when we do that, this is the kind of restatement that you get. So this column on the left tells you in US corporate bond external investment, according to TIC, how large are the positions. So this 8 here means that the official US statistics say Americans are exposed to, will own $8 billion of Brazilian corporate bonds. That's a residency-based notion. By contrast, the second column shows us what that position becomes when you restate as nationality using our algorithm, using our, the method I just described. It jumps from 8 billion all the way to 50 billion, an increase in 42 billion. I won't spend much time on it here, but we report this change in 2 ways. Tax haven only is when we only reallocate investments from tax havens. So we would give Brazil an investment by an affiliate that issued from Bermuda, but we would not give it any change if it issued through, let's say, a US affiliate. By contrast, with full nationality, we do everything. Any foreign affiliate of a Brazilian company, will merge. And again, one benefit we feel of what we're doing is that we allow for that kind of flexibility. I'll try and speed up a little bit here, but you can see that, the big countries that appear to be issuing through these tax havens and receiving money from developed market investors are these large emerging markets. China goes from what would have been almost zero exposure, $3 billion, all the way up also near to 50. Looks like in the raw data that the US doesn't even invest in Russian corporate bonds. By contrast, with our algorithm, they invest $12 billion as much. Where is all that money coming from? Like I said, you can see here highlighted in blue, instead of investing $30 and $80 billion in companies resident in Bermuda and Caymans, by nationality, we're basically going to take it all away. We don't take it all away for Ireland and Luxembourg because, like I said, there's some meaningful economic activity there, but we certainly take most of it away. You can do the same for equity, and let me just kind of skip the details here other than to again note that this is all available online, and in fact, you can see these patterns, which are not exactly the same for plenty of other countries like Europe and Canada and Australia, et cetera. We can sort of summarize the two patterns I just described to you. So here's one pattern I would summarize, which is if you look at the share of each of these countries listed along the x-axis, the share of their external bond portfolios that happen to be in the BRICS countries, Brazil, Russia, India, China, South Africa. Under nationality, you see it in the blue. It's really, huge percentages, something like, 7% of all US external investment in bonds is in those countries. By residency, it more than halves in the US, but it is quite heterogeneous. It doesn't change really at all in Norway. It drops by most, at least on a percentage term, either in Australia or Sweden. You can see there is heterogeneity. And the other pattern I emphasized is that equity investment, which looks to be very heavily concentrated in tax havens, a lot of that shifts toward China. We associate external investment in the Caymans, for example, almost, very largely to China. And so the picture for equities here shifts as well, where you can see, it looks like 10% of all US investment in foreign equities are in China, did I get this right? Let's see. Nationality, residence. Sorry, I said it wrong. The red line captures residence. So whereas, I said this wrong on both slides, sorry. Whereas 2% of US investment in foreign equities appears to be in China under residency in the official statistics. In our restatement, the line goes up. It's the blue line that we think is sort of the more meaningful one, all the way to 10%. Now, here's just a summary. You all have the slides, so I'll let you look at the numbers on your own. But again, big dollars here, these reallocations. And there's implications for this big gravity literature, or really anything that uses CPIS as a data source. This is essentially Sam's question, but he was sort of asking, have you done it? And the answer is no. We hope lots of people will help us do it. Now, one other thing, I mentioned earlier that government bonds are almost never reallocated, because governments don't issue through foreign affiliates. So our algorithm is really about changing around where corporate bond investment is associated. And so that one implication is it means that when you ask questions like, how much of US investment in Brazilian bonds is corporate versus is government, you get totally different answers. So, I know 20 years ago when I'm in grad school and I'm thinking I want to study US investment in Brazil, I might very well have said, well, I should focus entirely on government bonds because they account for, 30%, of 70%, government bonds in Brazil account for 75% of all US holdings of Brazilian bonds, meaning 25% of those holdings is in corporate bonds. Once we've taken the corporate bonds issued by, let's say, Petrobras's offshore affiliates and associated them instead with Brazil, the share of corporate bonds becomes 70%. It becomes a clear majority. And we see this pattern throughout. Jonathan, I saw a clapping on your screen.
Yeah, I thought that was a hand raise, but I see it as a clap.
I'll take the accolade, but
yeah,
also.
well, I clap too. It's a nice presentation. But I did have a question. Please. About litigation and default. Do we think that these tax haven bonds stand and fall with their parent?
Good. So
And
I'm
does
gonna
litigation and if there's litigation involved with these investments, is the tax haven the jurisdiction versus the parents?
It's an awesome question. So I don't have such depth to offer to answer it. I'll be able to double click a little more on this in the China case, where it's going to be a more nuanced situation I'll get to in probably 3 minutes. But one thing you're pointing out that I think is actually quite important, or potentially quite important in this current environment. I mean, I don't want to talk about current events, but related to COVID, there are some who believe there might be an emerging wave of corporate defaults. And compared to prior waves of corporate defaults, the fact that more and more debt is being issued through these offshore affiliates in tax havens means more and more jurisdictions are involved, not only in any legal issues, but even in government policies aiming to try to resolve this. There has been discussions and in some cases implementations, for example, where certain bailouts would be conditioned on a company not being headquartered in a tax haven. I don't have any slides on this, but I do wonder if we do see such a wave, that this issue is going to make things much more complicated and less predictable because it's an added layer of hierarchy legally and in every other way than we probably had seen more commonly in the past. It's a good question. Now, I talked about corporates looming a little larger than governments, but I want to emphasize that these corporate issuances also are largely in foreign currency. In other words, the corporate issuances from Petrobras Caymans, or from any country in the Caymans, in their Cayman Island affiliates, are not the same as the general class of corporate issuances, particularly in terms of their currency. They're much more likely to be dollar denominated or foreign currency denominated. And so as a result, there's even implications of this restatement for the foreign currency composition of the external portfolio position, the position of bonds. So for example, if you just study Brazil's bonds that are held by the foreign investors in our data, you see that about 40% in 2007 were denominated in Brazil's local currency, but by 2017, a majority is, something like 70% or so. And this increase in the local currency share of externally held corporate bonds, I shouldn't say corporate bonds, bonds, is something that people have noticed, people have commented on. If you instead tuck into the calculation the bonds that, let's say Petrobras is issuing through its offshore affiliates, which are less likely to be local currency denominated, you not only push down the level, but because this is a more common thing, you in fact largely attenuate or eliminate this trend at all. Now, to be totally clear, per Sam's question, if, and it's a very big if, but if there's a transfer of the funds exactly from the Cayman's affiliates to the parent, let's say via an intercompany loan, and if those loans are perfectly recorded as dollar denominated, then Brazil's overall currency exposure, external exposure, needn't change in terms of its composition. But for a variety of reasons, including in some cases for some countries data availability, in other cases because there's a presumption that portfolio investment, namely stocks and bonds, are the most volatile type of investment, there's been a focus, certainly by academics and others, on portfolio investment, bond investment per se, and all those statistics could be affected by this issue. I want to make sure to get to the China issue, which is I think a very important repercussion. So let me instead just kind of skip this, what we call spurious foreign investment, and instead just suggest that you take a look at it in the paper if interested. But another pattern that comes about from our restatement is just that, as I mentioned earlier, a significant amount of US and UK foreign investment we actually don't think should be thought of as foreign, in fact, at all. And again, I should also just give credit where credit's due. In a lot of those cases, it's something that had been recognized earlier. Like Irish tax inversions, of course, there's been a lot of work on. But one thing that's nice is we have this methodology to quantify and organize it across 9 investor countries. Okay, so for the last 15 minutes or so of the talk, let me jump into the implications of offshore issuance in the case of China. China is a little unusual, but as I showed you in the equity case, it's actually huge quantitatively. We're talking $600-700 billion of flows that were moving from tax havens to China in terms of when we associate, when we report the statistics under nationality instead of under residency for US investment, for example. Here's what's going on with China. So let me start by just providing a benchmark. So this is a baseline. This is not the case of China that I'm going to be focused on, but I want to fix ideas. Imagine hypothetically, China had no restrictions on foreign investment. So, and actually let me pause real quick here because I see Daniel Shu has his hand up. Daniel, you want to?
Yeah, it's just a very quick clarifying question. When you talk about China, do you include Hong Kong or not? Because traditionally Hong Kong is a very important offshore center for Chinese firms.
Right. So this is including, no, this is not including Hong Kong, but I will show you in a second. Let me make sure I'm getting this right. Yeah, I'm going to show you flow. So the answer is no, it's mainland China separate from Hong Kong, but Hong Kong will be integrally involved in this. Give me a second and please ask again if I don't cover it. So for now, let's assume China just allows foreign investment like anything else. Like, in the US, General Motors issues shares in the US and Europeans can just buy it. In that case, the Europeans would be these foreign shareholders and they would just buy shares that in that case would be like General Motors, but inside of China. And this would be the cross-border position, this line, this first line that's crossing the inside-outside China. Of course, Chinese shareholders also could in that case hold shares in the operating company and nothing unusual would be going on. But this violates Chinese restrictions, Chinese government restrictions on foreign investments in some of their key industries. So instead, they have something called a variable interest entity structure. That's this VIE structure, which is much more complicated. You can see there's a lot more boxes here on the right. But the key idea is we want to still be able to let these foreign shareholders, which you can see I'm circling, or I hope you can see the hand circling, still have access, have an investment position in the operating company. But we're going to intermediate it through this listed company, through an SPV, and through a WFOE, that's a wholly foreign-owned enterprise. It's actually, I guess, in the biz, pronounced a woofie. And in doing so, the key idea is to make sure that the companies can tell their regulators that the foreign shareholders don't have a proper equity claim on the operating company. On the other hand, it's designed so that the company can tell shareholders, you will be paid the cash flows associated with our operations in China, or at least have a claim on them, much as you would if it was an equity claim. And how do they do that? Well, there are these series of contracts you can see between the woofie, the Chinese owner, and the operating company listed here in the bottom right. The kinds of things that you see a capitalization where the woofie grants the wholly foreign-owned enterprise, which I'll show you in a second, is connected to the foreign shareholders. So I, in principle, could own a listed company, which itself wholly owns a woofie. That woofie then provides a zero interest loan to the operating company, essentially capitalizing it. There's a call option agreement with a pretty low strike price. So in principle, the woofie can claim that there's a mechanism whereby it could take control of that operating company. The operating company grants power of attorney to the woofie, and furthermore designates the woofie an exclusive provider to consulting services, where consulting basically covers the management of the firm. And the payment for such services is designed to be as close to the operating income as can be. So without spending more time on those details, this is this bottom part of the structure. Once you believe, or if you can convince the regulators that the woofie does not have an equity ownership claim of the operating company, now it's allowed to take foreign investment. So when Americans buy shares in Alibaba listed on the New York Stock Exchange, what's going on is the foreign shareholders, let's say me, buys Alibaba, which is actually a Cayman Islands company, which then wholly owns this WFOE, okay? To Daniel's question from before, this WFOE, or this SPV, for example, is commonly in Hong Kong. So a lot of the money does run sort of through Hong Kong. And I'll show you quantitatively what we see there in a second.
Sorry, Brent, what is SPV?
A special purpose vehicle that you should just ignore here. There's a lot of complexity here, but I don't think we'll need it for the next 10 minutes. But special purpose vehicle. Now, first thing we want to note is that these investments are risky because with this structure, there's a heck of a lot less shareholder protection than with this structure. I'm not going to spend time exactly on why, but there's evidence, for example, that shareholder claims would not be supported in Chinese courts as seriously as they would be if it was a direct equity ownership. And in fact, in case you want to Google it, I won't spend time on it, but the best example of this where something's already happened is when Jack Ma essentially extracted the assets associated with Alipay, which later became Ant Financial, the payment system with Alibaba, and Yahoo shareholders, which owned some of Alibaba, then sued and or complained and didn't fare well. That would be a good example if you wanted to double click on the issue. In any event, we are not the first to point out at all this risk. So there's papers in legal journals and all that. Instead, our point is just to quantify that it's a heck of a lot bigger than you might otherwise think. People might think, well, this concern of such appropriation of, let's say, U.S. investor capital by the Chinese, how big is it? Well, a natural thing to do would be to look in the U.S. national statistics. And if you did, you'd find a number like an $150 billion exposure, much lower than our, $600-700 billion exposure. Okay, but in the last 5 or 10 minutes, instead what I want to draw out is the implication for international macro of all this. And it's going to be about the net foreign asset position. So first, just a quick refresher. What is the net foreign asset position? It's the difference between a country's claims on foreign capital, foreign assets, minus L, the rest of the world's claim on that country's assets. So for the United States, when we hold a share in the Nikkei, that's a part of a US foreign asset. And when a Japanese citizen owns a share of the US, New York Stock Exchange company, that would be a US liability, okay? And the change in the net foreign asset position is not only the current account, sort of net income in every year, net foreign income in every year, but also valuation changes. So for example, if the stock price of General Motors went up, by $1 billion or $1 trillion overnight, you would want to count that as a deterioration of the U.S. net foreign asset position by about $1 trillion overnight. Why? I mean, think about what the net foreign asset position tells us in our models. It essentially would say how much of a claim in present value terms does the rest of the world have on, net exports, let's say, from the U.S. back to them. And if all of a sudden the rest of the world owns, a really much more valuable claim on U.S. assets embodied in General Motors, then you'd want that to show up in the net foreign asset position. And exchange rates and other things, for example, have been the focus of this a large literature talking about the importance of valuation changes. What we're going to show or claim is that because of this complicated offshore affiliate structure, when China's VIEs, and again, these are the giant companies that you're thinking of, JD.com, Alibaba, Tencent, Baidu, every single one of them is a VIE with some variant of the structure I showed you earlier. And it just so happens that they've increased quite dramatically due to valuation changes over the last 10 years. And we're going to show you evidence that those valuation changes were not included in the official net foreign asset position of China. And it's going to be enough to take them from the second or third largest positive NFA country. And it's going to make them instead more like Norway or Singapore. It's going to about halve the extent to which they're a giant net creditor. Again, there's a narrative on global imbalances being huge. The US essentially is a net borrower from the rest of the world. China is one of the very biggest net lenders. We're gonna make it look a lot less asymmetric between the US and China than that conventional narrative would argue. So here's how it works. And I should ask the organizer, Kim or George, I don't know, you can give a thumbs up if you don't want to, but can I go about 5 minutes? I think I'll grab about 5 extra minutes past 1 with apologies. So, okay, so here's the standard structure. Again, this is not what we're talking about happening in China. Thanks for the thumbs up. You can see that, let's say it was General Motors. This would be the example I'd be talking about, was the operating company. And the stock price of General Motors increased quite dramatically in value. Well, then these foreign shareholders, their external assets would go up and China's external liabilities would go down because, again, portfolio liabilities would be linked to the stock price. Instead, and we think it's because the link between this listed company in the Cayman Islands, which is the actual, traded Alibaba company, and China's, onshore operations, the WFOE and the like, because they're linked in a way that is FDI and is not a portfolio investment, what we're finding is that this link does not reflect changes in the stock price. And in particular, I'm just going to show you evidence that even though the Chinese VIEs, like Alibaba and all those guys, increased in value by like $1 trillion in a very short period of time, you're not going to see any evidence of that in China's net foreign asset position. And then I'll stop and I'll show you for other countries that you do see an equivalent movement as sort of a proof of concept. So here's the movement I'm talking about. If you look at the red dashed line, that's the market value of all these companies. Again, Alibaba, Baidu, JD, et cetera. Something like $2 trillion of value in terms of their stock market value. But one thing we're going to exploit is that about half of that, there's about a $1 trillion gain in a very short 5-quarter window, which you can see here in early 2017. This red line shoots up. So you would have expected that China's gross liabilities, foreign liabilities, would have shot up by about $1 trillion or some large amount, and therefore that their net foreign asset position would have deteriorated or collapsed by about $1 trillion or something like that. Okay?
But Brent, when you say the $1 trillion, why isn't it just the foreign share owned of that trillion? So
you are right. So for now, let me just say you are right, and I will show you our calculation. It would be less than $1 trillion. You're absolutely right. So because of the structure, it's a little more subtle, and I'll get to it. This I will be able to show you quickly. But remember that the bulk, almost all of the ownership is considered foreign, because the entity that owns, the Alibaba WFOE is actually a Cayman Islands entity. So even when the Chinese own shares in that Cayman Islands entity, when it re-enters China, it would be on the liability side. And on the other hand, your point is correct in the sense that it would also show up on the asset side. So the mismeasurement is not just on liabilities, and I'm not going to get into the details, but we do take it to account. And because these companies are largely foreign owned, what I'm saying is approximately true, and the numbers will be taking that into account. Okay, so where should this show up in particular? We think it should show up as FDI from Hong Kong, the British Virgin Islands, or the Caymans. Because in this structure I showed you here, the listed company and the special purpose vehicle are almost always in Hong Kong, the Caymans, or the British Virgin Islands. But you can see from the blue line here, the reported FDI from those places doesn't show anything even close to this increase. And in fact, in levels, there's a bit of a puzzle. It's lower in levels than the market capitalization allowed, even though this blue line should include a lot of FDI that has nothing to do with these VIEs coming in from Hong Kong and the like. Maybe we're too confident, or you might think we're too confident in our assessment that we understand this VIE structure, and that the implication would put those positions, those flows, or those valuation changes into FDI. So again, what we're doing here in this bar chart is I'm just zeroing in on this 5-quarter growth in the red dashed line. That's about $1 trillion of value, which you see in this red bar. If I look at the blue line, which shows FDI liabilities of China from Hong Kong, the British Virgin Islands, and Caymans, it's clearly not there. If I look at all FDI debt liabilities, it's clearly not there. I could look at any other possible category where it might, exist, including total liabilities after getting rid of reserves and trade credit. It's clearly not there either, okay? Now, if I'm claiming it should be, at least if the statistics, and I want to be clear, when I say should, I'm not claiming that China is doing anything incorrect. I'm not at all making a claim that China's not adhering as they should to national statistical practices. I don't know. What I am making a claim on is if we're going to use these data the way most macroeconomists would use them, it should be reflecting these changes. And other countries, in fact, do have them reflect these changes. So what I'm now showing you is a comparison. Let's look at US external holdings of common equity in the Caymans, which is largely, not entirely, but largely these VIEs from China, as I showed you earlier. And sure enough, if you compare those positions, that's in the blue line, to the market values evolution in the red line, they line up great. Another way to look at this would be to look at a major holder, investor of Tencent. We happen to know that about 1/3 of Tencent is held by a prominent, technology investment fund in South Africa called Naspers. And the blue line plots South Africa's, reported FDI to China against 31% of Tencent's market cap. And again, you can see it's the whole game. Works perfectly. So this is evidence that our claim that these things should move together holds for South Africa's external investments in these VIEs. It holds for US external investments in the Cayman associated with these VIEs, but we don't see it holding on inward investment to China for these things. I'm going to skip the details given timing, but Sam said, don't you have to think about the asset side, essentially, Chinese holdings of these positions? And he's correct. To get the net adjustment correct, you do have to think through this. And in the paper, we give you a lot of detail on exactly how we do that. And that's what's shown here. But when you take it all into account and you make a correction for what we think the NFA should look like, we start from this official position. So this is the official series in Chinese data. Chinese net foreign asset position peaked at about 30% in 2008, is down somewhere between 15 and 20% now. But if you take into account what we think of as missing increase in the value of their liabilities, because this offshore affiliate structure keeps out those valuation effects, or at least delinks China's valued liabilities from the stock price of their listed firms, we think the number is more like the red line, about $1.1 trillion lower, about half in percentage terms what it would otherwise be. We certainly consider, I'm sure this is imperfect exercise, so we consider a number of robustness checks. One example of something we can do is we can increase significantly beyond what we think is plausible our assessment of how much of these firms the Chinese own. That gets us to this short dashed line, which you can see on the top. We would have something more like an $800 or $900 billion gap. Maybe our assumption on the assets is too harsh. Maybe, in fact, the outward investment from China is tracked in a way that links with the stock value. Then you'd actually get a bigger mismeasurement. We consider a number of plausible sort of robustness checks, and we really just don't think this is going to, become any smaller than something that we think would be quite important and meaningful. Summarize this point, much more adjustment has occurred in these global imbalances, at least in China's, than you might think. Typically people, Obstfeld and Rogoff have papers from, a decade or two ago trying to ask how big would the exchange rate change have to be, to close China's, NFA position. And actually one thing, that we think has gone underappreciated is if we're right, about half of that position has already closed over the last 10 years. Furthermore, our whole work in general, there's this narrative out there that China invests and buys a huge amount of US treasuries, and it's totally asymmetric. Americans just don't buy anything issued by Chinese companies or China. And we're actually showing that, no, it's much more close to symmetric than you'd thought. The US happens to hold a very large value of Chinese equities and bonds. It just so happens that the bulk of those are intermediated through offshore tax havens, and so they don't show up in the standard statistics. Finally, and this is the last thing before conclusions, there is a lot of work generally comparing, and this is important for the trade crowd too, the behavior of portfolio investment versus FDI. FDI has always been treated as a slightly different kind of capital inflow, largely under the premise that it might be less hot, might be less likely to leave quickly in a crisis. If, for example, someone builds a factory in your country, they're less likely to immediately pull out to the macroeconomic detriment of your country. Blanchard and Eklund have a paper, for example, that looks at the dynamic behavior of FDI versus non-FDI and sort of puzzles, says they look more similar than we might expect according to that narrative. And we suspect that maybe this point that offshore tax haven-based issuance essentially converts what otherwise would have been portfolio flows into FDI flows. Because instead of just taking direct equity investments from abroad, you're instead having the equity investments go to an affiliate, which then is a wholly owned parent or subsidiary of the onshore firm. And that latter flow would be FDI. So we think this might be going on quite broadly around the world. So thank you for letting me go over. We have this novel view of global capital allocation. This methodology I do want to highlight, is available online, allows you to essentially reassociate with various different assumptions, offshore issuance with parents, and restate commonly used public data sets, in particular TIC and CPIS. I talked about the main implications being that it looks like there's a lot more direct portfolio flows from rich or advanced economy investors to large emerging markets. And finally, you can go to this website and download the data, use the code, and play away. Thank you.
All right, great. So let's open up for questions. Just raise your hand and then unmute your mic and ask away. Yeah, Daniel, go ahead.
Yeah, I think this is a really fascinating fact about China. Just a quick question about the time trend. Like, it seems like from we reported, it's widening over time, in particular after the 2008 financial crisis. So I just wondering if you have looked into what explained this widening discrepancy in the data.
I assume you mean the fact that the red and black lines here are quite close in 2008 and diverged from then?
Yeah, that's right.
It's 100% a function of the surge in value of these VIEs, companies like Tencent, Baidu. I shouldn't say 100%, but it's predominantly the fact that those, big, very valuable firms that I described that issue through the Caymans and Baidu and the Caymans and the British Virgin Islands and all that, they were worth much, much less in 2008 than they are today.
Okay, got it.
Joe, you're on the air.
Hey, how's it going, Brent? I just have a short question about the extent to which the spurious international positions you mentioned briefly as being fairly large for the U.S., whether those also have any multilateral impact on, in particular, on net positions?
Right. So in general, it's a little subtle. There would be a multilateral impact of some of those things for portfolio investment, in the sense of you would be eliminating some U.S. purchases of foreign bonds in total, right? If let's say, okay, so in that sense, yes. On the other hand, the investments assuming the money round trips the way we're sort of suggesting, and those are accounted for as something like an intercompany loan or an FDI, et cetera.
Right. Okay.
Now,
Got it.
okay, I think yeah, I think we'll leave it at that, but it's a good question. In the case of Ireland, for example, where it's, these are, well, let me leave it at that, but I should just emphasize that the two big contributors in the US to those results, and the paper sort of talks a little more about this, but are one, and I'm trying to show you here, yeah, one, CLOs, so collateralized loan obligations, where the underlying loans are largely U.S. loans. And this has been, documented before by Leo and Schmidt-Eisenlohr. And then the Irish tax inversions, Medtronic is a famous case. Those would be the most prominent types of quantitative contributors to the U.S. case. In Britain, for whatever reason, we haven't figured it out yet, but a lot of UK regional water suppliers like Thames Water, et cetera, issue, I think, out of Guernsey or some other offshore place. So those are the drivers of why these are huge for the US, moderate for the UK, and it's a much smaller deal for the other 7 countries in our data.
Great. Sam, go ahead.
I'm kind of naive on this, so there might be a really simple answer, which is I don't quite see conceptually why the portfolio investment and the capital gains on that or the increase in value on that is treated so differently than the FDI, because what is there some fundamental reason why it's done that way? So in other words, I don't really see why it should make so much difference if you don't own the company, it went up in value. You had it as portfolio versus you had it as direct investment and it went up in value. Why should that be treated differently? Which seemed to be kind of fundamentally what was driving your result about China. And I should say, I really liked your presentation. I always forget to mention that when I ask a question, but this was very nice.
Well, if you literally always forget, then I'm not sure.
Yeah. No. I always forget when it's really
Thank you,
good.
Sam. Okay. Okay. So the first statement I would make is the balance of payments methodology, the rules, the BPM 6, basically says, look, for FDI, there are a number of different ways that you can account for the flows or for the positions, I should say. There's discretion given for good reason, because a lot of FDI is super illiquid, it's complicated, it's not as easy as it is in this particular case when you can look at a stock price or something like that, or it's not as easy as portfolio investment, I should say, where you can look at a stock price. So there is sort of broad leeway that's permitted. Now, why is the flow that I described considered FDI? And therefore, why in principle would it allow for more leeway in how it's handled and accounted for? The definition is that when the investment is greater than, and there's actually different thresholds, but commonly it's a 10% threshold between the two entities, that's called FDI, compared to when it's a very dispersed or fragmented, non-concentrated position. So when someone buys a share of General Motors or owns a share of General Motors, they own, they don't have controlling shares typically, they own a very small amount. And so that's going to be called a portfolio investment. On the other hand, if you owned 60% of General Motors shares and you're, Canadian, that would be considered an FDI holding. In much the same way that if you owned 100% of some, small factory, that would be FDI. So that's the reason why this flow is considered FDI, in China instead of a portfolio investment.
Yeah, I think that part made sense, but I was wondering conceptually, and it feels like I'm repeating sort of the McGrattan and Prescott argument that if you had these big increases in valuation in your FDI, they're being missed, and you're sort of finding one piece of that you can bring back in, I think correctly, but I just wonder why shouldn't the effort be to value all the FDI that way rather than just this kind of one that's done with respect to US or foreign investment in China? Because I don't see the conceptual reason why you'd forget about the increase in value when it's FDI versus count it when it's portfolio.
I think the answer to your question is conceptually everyone is trying to value FDI as close as you can to the economically sensible notion of what it's worth. In some cases, that's hard, if it's a small private company or illiquid or something like that. But we think this is what the world is generally trying their best to do. And we happen to have found a case where we think there's a big mismatch. If we could access the microdata or something and really, hone in on exactly where the dissonance exists in this case, that would be fantastic. But these are usually confidential data that we certainly won't be able to get access to. Instead, what I would simply say, and what we at least found compelling, is there happens to be this beautiful case in the context of China where there's just no dispute that the market price of, the market cap of Alibaba and Tencent and Baidu and JD and, I don't know, these dozens of VIEs went up by something like $1 trillion very quickly. And so there's this just very nice, clean, clear kind of experiment, which is in that instance, economically, we would want that value captured. Now, that's big enough where we should be able to see it showing up somewhere. And, this is sort of the scientific evidence I can give you that it's not showing up there. We have, sort of had some discussions and looked into this as carefully as we can with some people we would consider closer to it. And we do think this is right, but we don't think we'll be able to do much better in terms of documenting that this is what's going on than sort of showing you these relationships. The proof's kind of in the pudding.
Brent, just to pursue that a little more, your first example with Petrobras, you said that was actually equity, and you briefly mentioned that aside from this transformation of the country of where the investment was going in, was also a transformation of debt investment or bond investment to FDI. So, I mean, the interesting question from a risk-sharing point of view, I think you've shown us that that the world in some senses, to the extent there was a positive China shock, that the world participated in that because they owned a lot of Chinese equities. But in the case of a Petrobras positive shock, that wouldn't have been going on because in your example, the US investors were investing in bonds rather than equity.
Well, okay, so first I think this is exactly what you said, but just to make sure everyone's on board now that I've gotten through the whole spiel. So the idea would be that, and Sam, this relates to your question, if the US simply, if I simply bought a share or a bond issued by Petrobras in Brazil, that would be a portfolio investment, a portfolio flow. And it'd be pretty easy if those bonds were liquid to value that using the market price, and it would be valued as such. Instead, it's a portfolio flow between the US and Caymans when I buy this Cayman Island issue bond. And that can be valued and tracked to the stock price and all that stuff very easily. If the money was then, sent from Caymans back to the parent company, because this is a wholly owned relationship, that would be considered FDI. So my point is, from the perspective of Brazil, they're ostensibly receiving money from US investors that want to buy bonds. That's portfolio investment. But from the perspective of the Brazilian statistics, they're getting FDI from the Caymans. That's sort of that translation point. To Jonathan's point, in bonds, to the extent you think, for example, Brazil has some disaster which is going to make Petrobras less creditworthy, and that would move, the value of, it depends what happens to the value of the Cayman Islands bonds of the Petrobras affiliates. And what I'm trying to show you is, to the extent, let me go back, because it looks like US external investment on our asset side, the US side, almost there, sorry, does track, here it looks like the US is correctly tracking in terms of its foreign assets, or the value of those foreign assets are linked to the stock price. of these entities that issue from, let's say, the Cayman Islands here. So in the Brazil case, if in fact something happens in Brazil that changes the value of the Petrobras affiliates bonds, it would show up. The question is, if instead I phrase the question as follows, Jonathan, we're worried there's going to be something that happens in Brazil in a month, or it just happened and we want to figure out what was the implication for US wealth. You would have a really hard time answering that question because you couldn't see that linkage. You'd see that the US investment positions in the Cayman moved up or down, but you wouldn't know what that was reflecting. And that's the way I would think about what we're offering here on the non-China examples.
Okay, Evangelos.
Can you hear me? Yeah, hope you hear me.
Oh, looks like you muted yourself.
There
There you go.
Okay, thanks. I'm very new.
No, you just muted yourself again. Here, let me unmute you. I'll do it. There you go.
Okay. well, yeah. Nice presentation. I really enjoy your talk, I have to say. I have a question, even if I've missed for some technical problems the first part of your presentation, and think it might have been answered. It's a more macro question. I mean, there's a lot of discussion about the post-COVID era and a new debt spiral crisis, particularly in the European Union, the Euro area, and even more in the emerging markets. There is, from the academic point of view, there's also the last year presentation by Albert Blanchard in the American Economic Association speech. He was talking about the cost of public debt when its rate are low. How do you see this public debt story goes on under this?
So Evangelos, I'm so sorry, but you've gone in and out, I think accidentally muting and unmuting. Let me try to just sort of say 3 points I think that relate to the topics you discussed, but I'd be very happy to follow up by email if you want to shoot me an email with the question. But the first thing is, you've talked a little bit about public debt in the sense of government debt, and I do just want to emphasize that one thing that comes across with our work is that the change is far more related to government debt than corporate debt, because of course governments don't borrow from abroad. So that's sort of one statement. So we do think that you can use the official statistics to get a pretty reasonable bearing on U.S. exposure to government bonds issued by Brazil, let's say. Next is really just to reiterate what I said in response to Jonathan Eaton's question, that I do think that if there is stress in the corporate debt markets around the world, the fact that a lot of these positions now involve 3 jurisdictions: country of an investor, typically a tax haven where an affiliate has done the issuance, and then a parent company elsewhere, there might be a lot more complexity this time around, something worth paying attention to. The last thing I'll just note is really, I think what both Sam and Jonathan were saying earlier, which is just, if you're anticipating this sort of stress or turmoil in the corporate market, it's not always easy to figure out where exposures are. And so, if you wanted to see how many Russian corporate bonds do the US own, and you go to the national statistics, you find the answer is 0. Our data suggests that the numbers could be quite different once you take into account this pattern of issuance. Thank you.
Okay. Professor Alessandria.
So Brent, this was great. So one thing I was just sort of trying to figure out was, in the case where you basically say the U.S. is not exposed to Russian bonds, but you would basically see that the U.S. returns are exposed to Russian bonds. So isn't there a way of backing this out, kind of the cross-border exposure by just the way the returns that U.S. We get out for U.S. In the U.S. current account in general, or if we basically see that all the Brazilian returns, so take Brazil, right? If returns on U.S. investments in Brazil on the Cayman Islands always mirror Brazil, then we kind of know that you're directly exposed to Brazil. So is there a way of using that insight to kind of
I'm not sure. Let me just agree with your first, I think underlying your premise is you're saying that, ignoring the China stuff for a second.
Yep, no, that was great.
Most of what we're saying needn't change the size or behavior, like we said, the multilateral position of the US, and that's correct, both in terms of its size and its returns and all that. If, in fact, all the money flows through one-to-one and the offshore stuff comes onshore at the same currency composition and all that, then I agree with that statement. Now, whether there's some other way to essentially get to our exercise directly from the dynamic properties of the, of the foreign assets, that's at least easier than what we gave you, or more reliable than what we just gave you. We certainly didn't see it, but I kind of hear what you're describing. It's
I wasn't clear enough, but I think thanks.
Okay, great. Hanan?
Thanks, Brett. I just have a very quick data question. So basically, does your data have anything to say about bank lending, for example, or even just a small fraction of the syndicated loan? Because a lot of the, if you look at residency measures, such as the BIS vocational banking statistics, you also see a large liability position to offshore financial centers in the form of bank lending.
Yeah, absolutely. So this paper is really just about portfolio investments, for the most part, modulo the China stuff at the end. But you're absolutely right that the conceptual issue that a lot of investments might be intermediated through offshore affiliates in tax havens and otherwise, applies much more broadly. And one thing that we're pursuing, sort of as a group of co-authors is trying to look at other kinds of asset classes, other kinds of investments. And the BIS has done awesome work, as you're alluding to, reporting and doing some comparisons very much akin to what we're doing for other types of positions and flows. Absolutely.
Okay, any further questions? Okay, then I think we can wrap this one up. Thank you very much for everybody who is attending. We will see you guys next week for Dan Ju, who will be talking about O-ring production networks.